The federal government has been hiking interest rates for several reasons, primarily to control inflation. When inflation rises, it erodes the purchasing power of money and disrupts economic stability. By increasing interest rates, the government aims to reduce consumer spending and borrowing, thus curbing demand and dampening inflationary pressures. Higher interest rates make borrowing more expensive, leading to reduced consumption and investment. Additionally, the government seeks to promote savings and investment. By raising interest rates, individuals are incentivized to save their money in interest-bearing accounts rather than spending it on goods and services. This increase in savings provides banks with more funds to lend to businesses, stimulating economic growth and attracting foreign investors seeking higher returns. Another crucial reason behind interest rate hikes is to tackle asset bubbles. Rapid and unsustainable increases in asset prices, such as real estate or stocks, can pose significant risks to the economy. To prevent the formation of asset bubbles and their eventual collapse, the federal government may opt to raise interest rates. By making borrowing more expensive, higher interest rates discourage speculative investments, thus mitigating the risk of asset bubbles. Additionally, interest rate hikes can influence exchange rates, helping the government manage the nation's currency value. When a country raises its interest rates, it becomes a more attractive destination for foreign investors seeking higher returns. This leads to an increase in demand for the domestic currency, resulting in its appreciation relative to other currencies, which can benefit the economy by making imports cheaper and reducing the cost of servicing foreign-denominated debt. While hiking interest rates serves several economic objectives, it comes with potential drawbacks. Slower economic growth may occur as reduced consumer spending and business investment impact overall economic activity, potentially resulting in job losses and decreased business profitability. Furthermore, higher interest rates burden borrowers, including individuals with mortgages, businesses with loans, and governments with outstanding debts. The increased cost of borrowing can strain budgets and limit financial flexibility for these entities, potentially dampening economic activity further. As policymakers navigate the complex interplay of interest rates and economic conditions, finding the right balance becomes crucial in fostering a robust and sustainable economy, ensuring the overall well-being of the nation's financial system and its citizens. Over the past few months, there has been a noticeable shift in the global economy as central banks in various countries have increased their interest rates in response to mounting inflationary pressures. These hikes were implemented as a measure to control rising consumer prices and stabilize the economy. While the decision to raise interest rates aimed to curb inflation, it also led to some significant consequences. On the positive side, higher interest rates have encouraged greater savings and reduced borrowing, helping to moderate the inflationary surge in some regions. However, the downside has been felt in the housing and consumer sectors, with mortgage rates increasing, making borrowing more expensive and dampening demand for big-ticket purchases. Moreover, businesses reliant on borrowing for expansion have faced higher costs, potentially affecting investment and growth. In summary, hiking interest rates in the past months had a dual impact on the economy, managing inflation to some extent, but also posing challenges to borrowing-dependent sectors. As the global economic landscape continues to evolve, policymakers must tread carefully to strike a balance between combating inflationary pressures and supporting sustainable economic growth. Jerome Powell, the chairman of the Federal Reserve, made the decision to halt interest rate hikes in response to the prevailing economic conditions and data analysis. The Federal Reserve closely monitors various economic indicators such as inflation, employment levels, and GDP growth to make informed decisions about monetary policy. After a series of interest rate increases to counter inflationary pressures, Powell likely decided to pause further hikes to assess the impact of previous actions and evaluate the overall economic trajectory. The halt in interest rate hikes could also be a cautious approach to support ongoing economic recovery, particularly in sectors that may have been affected by the prior rate increases. Additionally, external factors such as global economic uncertainties, trade tensions, or geopolitical events could have influenced Powell's decision to adopt a more cautious stance until the economic outlook becomes clearer. Ultimately, the move reflects a careful balancing act to maintain economic stability and mitigate potential risks in an ever-changing financial landscape. Bloomberg reports that in the upcoming Federal Reserve meeting, Jerome Powell is expected to signal a more hawkish stance, considering the recent surge in inflation. The outlet cites sources close to the Fed, suggesting that policymakers are likely to resume interest rate hikes in an effort to combat the inflationary pressures. The focus will be on Powell's communication about the pace and timing of these potential rate increases, as well as any forward guidance on the unwinding of the Fed's bond buying program. According to CNBC, market analysts anticipate that Jerome Powell will maintain a cautious approach during the next Federal Reserve meeting. They expect him to emphasize the Fed's commitment to supporting economic recovery while closely monitoring inflationary developments. The outlet highlights that Powell might address concerns about the impact of the recent interest rate hikes on certain sectors, and investors will be keenly observing any signals on the possibility of a pause in rate increases. The central bank's projections for future economic growth and inflation will be under scrutiny as well. Reuters suggests that Jerome Powell is likely to strike a balanced tone in the upcoming Federal Reserve meeting. The outlet indicates that while the Fed chairman acknowledges the persistence of inflationary pressures, he may reiterate the transient nature of some contributing factors. Powell is expected to stress the need for a data-driven approach to monetary policy, indicating that the Fed remains flexible in its response to evolving economic conditions. Market participants will be closely monitoring Powell's remarks for any hints on the timing and pace of future rate adjustments, as well as the central bank's assessment of potential risks to the economy. The Wall Street Journal reports that there is a growing consensus among economists that Jerome Powell will advocate for a cautious approach during the upcoming Federal Reserve meeting. The outlet notes that despite mounting inflation concerns, Powell may emphasize the importance of not prematurely tightening monetary policy to avoid derailing the economic recovery. He might signal a willingness to tolerate a temporary period of higher inflation, given the backdrop of supply chain disruptions and pandemic-related distortions. However, the Wall Street Journal underscores that any shift in language or policy direction from the Fed's chairman could have significant implications for financial markets. Experts have varied opinions on what Jerome Powell will do in the next Federal Reserve meeting, but a prevailing belief is that he will adopt a cautious approach. The recent surge in inflation has put pressure on the central bank to address the issue, and while some expect Powell to signal a more hawkish stance and resume interest rate hikes to curb inflation, others anticipate he will maintain a patient and data-driven approach. If Powell leans towards a more cautious stance, the stock market might react positively, as investors may interpret it as a sign that the Fed will support economic growth without aggressively tightening monetary policy. On the other hand, if the Fed signals a more aggressive approach to tackle inflation, it could lead to increased market volatility and corrections in certain sectors. For individuals, a cautious approach from the Fed could mean continued support for borrowing costs, aiding those seeking loans for homes, cars, or business expansion. However, it may also prolong the impact of inflation on consumer prices, potentially affecting purchasing power and overall cost of living. Ultimately, the market and individuals will closely scrutinize Powell's decisions and communication, as they have significant implications for the broader economy and personal finances. If you enjoyed today's video, please take a few seconds to leave a like, subscribe, and leave a comment about what you think Jerome Powell will do next. It's only a few seconds out of your day, but such feedback has immense value for creators like me, especially with a new channel like this. Thank you for watching, and see you next time for more finance, economic, and business-related news.